how you're going to be doing the federal income tax withholding. Okay, hi Jason. All right. So this is it for today. We're going to take a look at the W-4 form, which is the form, if you recall, that employees fill out when they first start working at an organization, or when they have some sort of change that necessitates them filling out a new one. So that would be some sort of personal change in their life, like they get married or they get divorced, they have kids, that sort of thing. Those are items that would affect the information that would be on an employee's W-4 form. So I want to go through that, take a close look at that, because we're going to be using this. This is an integral piece of this is an integral document that we have to use in order to do the calculations for federal income tax withholding. We're going to take a look real briefly at the two methods of withholding. We're going to go in more detail on Wednesday on those two methods. We'll go through step by step how to use them. I'm just going to kind of give you an introduction today in the difference between those two methods and why we would use one method over another. Okay. And then we'll look again, looking at the W-4, we're going to talk about 4 pieces of information that is required at a minimum in order to calculate federal income tax withholding. So if you get these 4 pieces of information down, and it doesn't matter which method you use, these are the same 4 pieces of information that are required in order to do the calculation. Now, I said at a minimum because there are certain circumstances where you may need some additional information, or the employee has provided additional information on the W-4 that then is integrated in that calculation. But at a minimum, for every employee and for every calculation of federal income taxes withheld, you need these 4 pieces of information. So we'll go through what those are. So any questions before we get started? Okay. So let's take a look at the W-4 form. And this one, I've got the 2023. Do you know, does your book have the 24 one? I don't know that there's any difference between the two. But you'll see up here, if there are any differences, I mean, each year has its own form. So, but we'll go ahead and use this one for now. Like I said, I don't think there are any differences with the 2024 form, if that's what your book is using. So, first piece of information that we see, the very, very top information is just personal information about the employee. What's their name? What's their address? What's their social security number? So that is required for them, or they may have a taxpayer ID number that allows them to work, but that would be a required piece of information. I mean, all of this is required, but just note the social security number would go up there. This part here is filing status. And if any of you have ever filed your own tax return before, you know that in order to file your tax return, your income tax return in April, you have to know what your filing status is. So this filing status on the W-4 corresponds with the filing status that the employee has used or plans to use for their individual income tax return. Now, this is one of those required pieces of information that we're going to need in order to do the calculations properly. This is also a piece of information that you as a payroll professional cannot answer for them. As a payroll professional, you're not really allowed to give tax advice, and that would be considered tax advice. So if you had a employee that came in and was filling this out and said, hey, I'm not sure what my filing status is, can you help me with this? You can help read the instructions with them and kind of go through that. But as far as making that final determination, they would need to consult with whoever does their taxes for them, right? If they needed additional help over and above just looking at the instructions. But there are 5 filing statuses, but you can see we've got 2 of them are grouped together. That's because in the calculations for federal income tax withholding, they're treated the same. So it's kind of the same calculation, that same information. So we've got single, which is just that, single. Somebody is unmarried, and this is as of the end of the year, as of December 31st. What if they are single? If they're not married, then they very well may be single. There's an exception to that if they happen to have a dependent that they're caring for, that they claim on their tax return. They may be classified as a separate filing status, which is called head of household, which is down here. I'll talk about that in a minute. But single or married filing separately. Married filing separately simply means that they are married as of the end of the year, but they're choosing to file their tax return on a separate tax return from their spouse. So they, for whatever reason, and there are multiple reasons that somebody may choose to do that. Usually for tax purposes, that is not the most advantageous filing status, but people choose to do it anyway. But this means that they're married, but they file their individual tax returns separately from their spouse. So that's the first checkbox there, single or married filing separately. Second one, married filing jointly or qualifying surviving spouse. Married filing jointly, again, this is someone who is married, but they choose to file jointly together, meaning they combine all of their income and all of their expenses together on their individual income tax return with their spouse. Okay, that is for married individuals, that's the most common filing status, but you do see some individuals filing as married filing separately. This other one here, qualifying surviving spouse, this means that the individual is, they're a widow or a widower, and within the last 2 years, their spouse passed away, and they have a qualifying dependent on their tax return. So it's a very specific circumstance. You don't see it quite as often because generally people can only use it for 2 years. It's the first 2 years after their spouse passes away. But that's what that is. So qualifying surviving spouse. Last one then is head of household. So unmarried, and you pay more than half of the costs of keeping up a home for yourself and a qualifying individual. So single parents usually will file as head of household, but it's not just for single parents. You may have this person that is qualified, that you pay more than half of the costs. This other qualifying individual could be a parent, could be, it could be a different type of relationship. Yeah. Yeah. It's a very common filing status. You do see it a lot. But again, I'm just giving you this as sort of an introduction, an overview of what the difference is between those filing statuses. As a payroll professional, again, you wouldn't advise somebody, oh yeah, you should file as married filing jointly. Definitely. That's going to save you a lot of money because you're giving tax advice and you're not able to, because tax advice is legal advice. And so you don't have that unless you're a CPA, then you could go ahead and give that advice, or an attorney. But you don't know what their personal situation is. That might not be the best filing status for them, because this is even though this is the first question on a tax return, it's often one of the most difficult questions to answer. Seems like it would be easy, but a lot of times it's not. Yeah. Yes, you have to have some sort of dependent that you are caring for and that you are paying for and keeping up a household for. Okay, so that's one of those really important pieces of information that needs to be on this form, and we're going to extract that information when we do the calculations for federal income tax withholding. Now, you can see here, complete steps, and all the instructions are right here. There's also a second page of instructions as well, and some supplemental worksheets. Oftentimes people don't use those. They'll just use this first page. But there is the step-by-step instructions are on this form. It's just a matter of reading them, which a lot of people tend to skip over. So this next one, complete steps 2 through 4, only if they apply to you. Otherwise, you can skip to step 5. All right, so Does it apply to us? For step 2, if you have multiple jobs or if your spouse works, if you have a spouse and they work, then you would fill out this form. If you're just a single person and you have only one job, you wouldn't do anything with this part. Okay? So what we're mostly concerned about, so there is this multiple jobs worksheet where it's a very involved calculation that you go through that helps to determine how much the withholding is. We're not going to use this. Hardly anybody uses that. I mean, there may be some circumstances. What we're mostly concerned with here and what we're going to use is this part C. If there are only 2 jobs total, so if you figure a married couple and both spouses are working, okay, 2 jobs, but only 2 jobs, you may check this box. Do the same on the W-4 for the other job. So if you've got one spouse that checks this box, the other spouse needs to check this box as well on their W-4 at their job. So this option is generally more accurate if pay at the lower paying job is more than half of the pay at the higher paying job. So we're talking about two jobs where the pay is within 50% of each other. So one spouse is making $50,000, the other spouse is making more than $25,000, then they should both check that box. Okay. Otherwise, if that's not the case, if there's a big disparity, so one spouse is making $100,000, the other one is making $25,000, in that case, they may want to use this multiple jobs worksheet. Then it would be more accurate. For our purposes right now, we're not going to worry about that multiple jobs worksheet. What we're going to concern ourselves with is this checkbox, and it is referred to as the checkbox. It's another piece of information that is required in order to calculate federal income tax withholding. So I said there were 4 minimum pieces of information. We've already looked at 2 of them. Filing status is one of them. Checkbox. Is that box checked or is it not checked? Okay. So that would be another piece of information that's required. Step 3 here, and it says also, so there's some additional calculations you could do if you have self-employment income on page 2, but again, we're not going to worry about that right now. Okay, step 3. This is not one of those minimum required pieces of information because it pertains to individuals who have dependents, and not everybody has a dependent. And in fact, mostly dependents who are children, for the most part. Now, there are 2 different credits that this is referring to. One is the child tax credit, which if any of you have children, you're probably familiar with. Child tax credit, which is a credit that is claimed on the income tax form where you get $2,000 tax credit for each qualifying child, which essentially means you get $2,000 off of your tax bill for each qualifying child. The other one is called the credit for other dependents. So if you have a dependent, but they don't qualify as a qualifying child, like they turned 17 during the year or they're older than 17, then they no longer qualify for the child tax credit, but they get this additional type of credit called the credit for other dependents. It's a much less generous credit. It's only $500, but still it's $500 off of their tax bill. So this section only pertains to individuals who do have dependents, who would fall under those categories. Again, if an employee is not quite sure if a dependent qualifies them for one of these credits, that's not a question that you would answer. You'd tell them you're going to have to talk to your tax advisor to determine that. And when I was a CPA, I would have a lot of clients who would say, hey, I just started a new job. Can you help me fill out this W-4 form? And so that's what we would do. We'd sit down together and we'd fill it out. So tax advisors are used to getting those types of questions from individuals. So this, again, like I said, it's not a required piece of information because not everybody has dependents. But if someone has one or more dependents that qualify, then they would need to fill this part out. But They don't have to fill it out. What this is going to do when they fill it out is it's going to reduce the amount of withholding. Like I said, they get this credit on their tax return, but by filling this out, you essentially are getting it ahead of time. And it's spreading that credit out in the form of reduced withholding throughout the year. So even if they have dependents that qualify them for that, they don't have to fill that out. If they don't want that additional withholding, they don't have to fill that out. Also, only one of the spouses should claim that credit because these credits are on the tax return. And remember, the tax return is if it's a married couple, it's probably filing jointly for them. Say they have one child. They get $2,000 credit on that one tax return. Well, both employees can't claim that $2,000 on their W-4 forms because now they're getting a $4,000 credit. And when it comes time to do their taxes, they're only getting a $2,000 credit. So that means that they're going to actually have to pay it back at that point. So only one spouse should be filling this out. Now, if you have two kids, one spouse could claim one kid on their W-4, the other spouse could claim the other kid on their W-4. You could certainly do that. But otherwise, you're claiming too much of a credit, and you're going to have to pay extra then when it comes time to file your taxes. So this one, it says if your total income will be $200,000 or less, or $400,000 or less if married filing jointly. So individuals whose income is above that level do not qualify for these credits. They do not get these credits, and so that's why that is indicated here on the W-4 form. Multiply the number of qualifying children under age 17 by 2,000. So if you've got 3 kids, they're 16, 8, and 2, you'd take 3 times 2,000. If you've got a 17-year-old, though, one of them is 17, but you got 2 under, one of them is 17, the other 2 are under 17, you would take 2 of those kids times $2,000, so $4,000 here. The 17-year-old would go down here. So then you would get a credit for $500 because it's the year they turn 17, they no longer qualify for that child tax credit. It's kind of crummy because that's when they really start to get expensive. I mean, they're expensive before that anyway, but that's when they get super expensive. So this is filled out only by individuals who have a dependent. And then the total of those 2 lines is listed here on line 3. If this is filled out, it will become part of the calculation. Okay, but like I said, not everybody's going to fill that part out. Step 4, this is for supplemental income. And again, this is at the discretion of the employee whether they want to fill this out or not. It's optional for them. If they have other jobs or other types of income where they don't have taxes withheld, they can claim that income here and have withholding through this job for that other income. So for example, say they've got a savings account that has a bunch of money in it, and they earn $2,000 of interest every year on it, but there's no tax withholding. They're going to have to pay tax on it, but there's no tax withholding from the bank. So what they could do is they could claim that additional income here, and their withholding through their job will go up in order to accommodate that additional amount of tax that they're going to owe. Does that make sense? So they can claim additional. Also, deductions. So if you think there are 2 different types of main deductions on an individual tax return. One is the standard deduction, and it's just a flat amount, and it's dependent on your filing status. So, and it's a pretty generous amount. I think for a married couple filing jointly, at least in 2025, it's almost $29,000. So what that deduction does is it reduces your taxable income by that amount. But you also have the option, and you guys are all going to learn this in detail when you take income tax accounting. There's a separate deduction for called it itemized deductions, where maybe you have other deductions that qualify as itemized deductions, and when you total them up, it's more than the standard deduction. Things like home mortgage interest, things like real estate taxes or state taxes paid, things like charitable contributions or medical expenses. All of these items have their own limitations, but if an individual's itemized deductions are more than that standard deduction, then it makes more sense for them to take you get to choose whichever is most beneficial. Whichever is going to get you the lowest tax bill is what you get to use. So if an individual itemizes their deductions, there is a separate worksheet that they can go through, and the result of that worksheet would go here on line 4B. So this, line 4A, would be an additional amount of withholding that would occur because it's additional income. Line 4B would be a deduction in the amount of withholding or reduction in the amount of withholding because it's a deduction on their tax return. So this would be a plus, this would be a minus as far as the income tax withholding is concerned. For your problems and what the book is doing, we are not using step 4, okay? But you do need to be familiar with what these mean. Line 4C is just for extra withholding. Let's say that the employee is familiar with how much withholding they're going to have. They always, they know what their income is. They always have $200 of withholding every paycheck, but it seems like every single year they haven't paid enough in. They're just not having enough withheld. Well, they can choose an additional amount. So if they're paid 24 pay, on a semi-monthly basis, so 24 pays during the year, and they're always having to pay like $1,200 every year for taxes. Well, what they could choose to do is to pay that over time in the form of withholding. So they could have an additional $50 every paycheck withheld from their paycheck so that they don't owe that big amount at the end. Which, by the way, if you owe more than $1,000, you may have to pay a penalty. So that's why they may be, they would be motivated to have that extra withholding here. So it's just a way for people to pay extra in, or maybe they like getting their refunds, right? Hey, I want to get, this is the best way that I know how to save. So I'm just going to sock away $100 every paycheck. I'm going to do it in the form of withholding. Now, it's not the wisest choice. Best choice would be to put it in your own bank account and earn some interest off of that. But for some people, they just don't have the discipline to do that. And so they look at those tax refunds as a savings vehicle, a way for them to save money. So they could have extra withholding. So that's what you would put here on line 4C. It's just any amount that the employee wants. And so this would be, line 4C would be an additional amount of withholding. So 4A increases the amount of withholding because it's more income. 4B decreases the amount of withholding because these are deductions. Line 4C would also increase the amount of withholding for the employee. Okay? Again, step 3 and step 4 are not required because they do not pertain to every employee. Okay? And then the employee has to sign it. They do sign it under penalty of perjury, meaning if they lied about something on here, the IRS can come after them. Right? And the IRS does. This doesn't go anywhere. The employer keeps these forms on file, but the IRS could come in at any time and inspect them. Right? So if an employee is claiming a bunch of kids that they don't really have, that would be, and then they sign this form, they have perjured themselves, they have lied on essentially a legal document. Okay. So again, that's not the payroll professional, that's not their responsibility. It's not your responsibility. The great thing about not being able to give advice is you also don't have then the responsibility for the advice that you gave. Right? So that is the crux of the W-4. You'll notice if you've filled out a W-4 from 2019 or earlier, it looks a lot different than this. And we're going to look at that at the very end of this chapter. We're going to look at what changed. But these are the W-4. So you can see why an employee would fill this out at the beginning, because we need this information. We need to know your filing status. We need to know if you're going to check the box or not in order to properly calculate your withholding. And you can see that if something has changed, like they had a child, or their child turned 17, so now is no longer eligible for this credit, but is eligible for this credit, or they got married and their filing status has changed. When those events, those life events happen, the employees need to fill out a new W-4 form, and that will change the calculation for their withholding. Okay? Questions about this? Oh my gosh, it's almost 1:20. All right. So, like I said, I think the 2024 one is pretty much the same. Okay, we have these two methods for calculating withholding. Both of them result in almost the same amount of withholding. One of them is a little bit more detailed and a little bit more specific. We have the wage bracket method where we just use a table. We take our 4 pieces of information that we need and we plug it into the table, and from that we extract the information that we need we extract what the withholding number is. Really simple. It's just a table. The second method, the percentage method, involves some calculations. We're going to go through that. This is the one that most students do kind of struggle the most with in this chapter, is this percentage method. There are a lot of steps to it. However, the instructions are there. You just have to be able to read the instructions properly. Okay? So the 4 pieces of information that we need. We already talked about 2 of them. Marital status, filing status from the W-4. Checkbox, was the checkbox checked, yes or no? The other 2 pieces of information aren't on the W-4 form. What are the taxable wages? That would involve our calculation of taxable wages, right? We're going to subtract any pre-tax amounts, take our gross wages, subtract any pre-tax amounts that maybe the employee has paid, something that reduces their taxable income. We may have to add some taxable fringe benefits to that amount. So these taxable wages have to be calculated by us, but we provide that information. The 4th one is how frequently are we paid? Biweekly, semi-monthly, weekly, monthly. We would have that information at the ready. Those are the 4 pieces of information that we need, and we need all 4 of those regardless of which method that we're using. Now again, we may need some additional information from that W-4 if they've got kids and they claimed them, or had additional income and claimed it and all of that. But at a minimum, need this from every employee. All right. That is it for today. That was fast. I know. Thank you for showing up.